Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, March 29th, 2022. I'm going to start out with a quick update on the equity markets like I usually do, and then just quickly highlight, the core asset classes I'm trading right now. I fired off a few posts to you this morning. You probably already got those. Covered the short on the crude, reverse that to long, put hard buy signals on gold and silver, buy signal on treasury bonds, and reiterated my short on the markets. Now, I'm going to start there and just, quickly, talk about, again, I always try to bring this up, the benefits of diversification. Started shorting the Qs a couple days ago, which down on that position, but not by much, and almost immeasurable compared to the gains on crude oil lately. You've been going long and short that one in the last couple of weeks. Just covered a short today, actually I'm going to share an update on the lumber trade. I told you I covered that one the other day, and now I'm long on lumber, so that's a new setup for you here. Might get a bounce there. And then, of course, Treasury bonds are rocking today so far. Let me go over the charts of QQQ and just tell you right now, there's really not much that's changed. We popped up today, and I made it clear, I think, based on my outlook for Treasury bonds, it just meshes with this. It's not to say, let's assume that I'm right on treasuries, and I may still be wrong on the market. Sometimes treasuries will go up and the stock market will as well. But typically you're going to see a flight to safety, and we're right to, what I believe to be a golden shorting up. Only time will tell if I'm wrong. I can just tell you it's objective. When you are below trend on the Nasdaq 100, which we are here, the blue line that I have right here is the 200-day simple moving average. It capped once we broke it right there, it capped both those pushbacks. And we had a big drop from there, and we had another one here. And I've gone over this many times over the years, where you can go back for decades and look at it. Easy to do on a weekly chart. Just plug it in as a 40-week moving average, or 40 period on a weekly, and you can again see that often, just as it did back here in that big drop in the fourth quarter of 2018, once you broke it, it proved resistance. You had two tradable bounces, and this one was about the same amount in time as well. That's what's interesting, is you can see as I zoom into the Q4 2018 correction, bear market, whatever you want to call it. It was a 20% drop in on average, if you count the small caps and the Nasdaq 100. S&P did a little less. You can see there, we had it. We took it out on this candle. Came back in the following week and the week after that and tested it. And then you had a final test of the 200 simple moving average right there, the blue line, almost a perfect test. And that was 1.4 months later, or 1.4 months after. So 1, 2, 3, 4, 5, 6 candles later. And just want to talk about now today. So there's the breakdown candle, and we're at 2.2 months later. And you can see, of course, what happened then. Once you kiss that, then the big leg came. So, hey, I'm going to be right or wrong. And as I say, if I think something it's all about risk reward. Should we get that other leg down, the risk reward is above average. You don't get many like this in the market. What do I mean by that? Well, like I said, anything much over 380 really is just does not support or mesh well with the bearish case. Anything can happen, but you're talking, so if you took a shot here at the 200 this morning when I mentioned that, I got that post out to you, we're starting to reverse off it already, and let's say you gave yourself a 5% drop, 5% stop, I'm sorry, from that level. And now let's also assume that we go on to hit my next, and I talked about this before. If we hit my next target in QQQ, I would put very good odds we're going to hit my final target. So at that point, a 5% stop, and to hit my final target, you're talking a 37% reward. So you're risking 5% to make about 37, and that is a tremendous risk-reward ratio. Better than 7 to 1. So that's the way I view things. I'll take those every time. And then again, let's now talk about all the other things out there. Let's talk about crude oil real quick. getting these quick trades. We had longs, short there, longs there. Batting damn close to 1,000 on crude lately. Had a couple early entries back here. I got stopped out in the last couple weeks, but overall, for a while there, I stood back when the whole Ukraine thing started. Just let it run, and then the chart started just really setting up nice and swinging these divergent lows and divergent highs, and most of these are easy, quick double-digit gains like this one, and that was provided as a setup before it even broke down with an entry to come on the breakdown. It was a 14% drop. And so far, if you reversed, and remember, again, these are actual support levels. I say this all the time, but I want to reiterate, you want to cover a short before support case. And in almost every instance, the buyers do step in early. So you can see, the low of the day was a hair above that 98 support level, and that's where a buy to cover order should be sold. Just like the bounce, somebody asked, Randy, I see I drew arrows that bounce up to 101.90, which we're at, and what I said is I may just trail up stops, and that's what I'm doing now at this point. I'm going to test trail stops up, and that way I'll assure at least a decent profit, a quick bounce. Off the lows this morning, I have to measure like this and move that up there. Oh, nope, I can't do it on that indicator. Yeah, whatever it was a decent bounce. And remember, I know a lot of you guys don't trade, guys and gals don't trade futures. If you do, MCL, there's there's QM, I think it is, and MCL, and they trade on the same price levels. They just have a smaller leverage factor. This is the smallest one. That's a great starter thing to get cut your teeth on trading futures. And QM has a higher leverage factor, and then this one, CL, is the highest. They call it a multiplier. It's you take the price, whatever crude's trading at, and multiply it by the multiplier, and that's your leverage factor. Anywho, those are the trade ideas, and of course, when I threw this one out there, I mentioned SCO as an alternative. So that was on March 24th, the morning of. We broke down. But it was in pre-market, and see, let me go back to that real quick, and this is why I like futures. The breakdown, you don't even have to be awake. It could have broke down at 3 in the morning, and not all, but most trading platforms allow you to do sell stops. You can have zero position, and you can set a sell stop to trigger if a stock drops below a certain thing. It's just like a buy stop. If you are bullish and you want to trade, you're trading the futures NQ, and have a bullish falling wedge, and the breakout point's going to be whatever it is. Let's say it's just pick a number 100. You can have a buy stop that says buy if it crosses 100. And it'll put you in the stock. It's like using stop loss orders, but they take you out of a position, as does a sell limit order. Whereas buy stop or sell stop orders will put you into a position. And that's all I was trying to point out here. Is that wasn't super early, but it was that morning of. And I'm just going to show you on SCO. Again, that was the morning of the 24th. And if you took SCO, which has a little bit of juice in it. I think it's 2-time leverage, if I'm not mistaken. That was listed as a proxy the morning of the 24th. Well, we'll look at the 60-minute chart. That would have been the breakdown that would have been right here, the breakout, because you had a downtrend line. And so SCO was good for roughly, you grabbed it at the open, it gapped up, so you didn't have the as of an objective an entry or as good an entry price as the futures, but you made 21%. And again, so that's, there's just, and keep in mind, guys, too, there's much more volatility. Crude moves a lot faster, so you don't put as much in crude as you put in the S&P 500 or Apple or even the Nasdaq 100. I always talk about beta adjusting your position size to account for risk, but let's move on. So either way, that's the crude oil. Talk about the metals. I really like those. Told you in the video, I think it was just yesterday, the euro was set up in a bullish falling wedge pattern right there, poised to break out. You could take it as a pure play. If you did, that was one of the sharpest moves in a while. And this is lately with volatility high, even though it's abated somewhat recently with the rally in the stock market. Technical analysis, at least my style, is working very well. This was the level, first target, laid out in advance, 111.66, and that's what we hit to the button almost, close enough for government work here. You can see there it is in a reversal. And so I threw that out today, and hopefully there wasn't confusion. So that is a buy. It's a strong buy. That's what you want to see on a breakout. That's what you call impulsive. Boom, ripped right up to the first target. If you're trading euros, you made a very nice trade. If you're a forex trader or just trading the futures, pull back. You can game the bounce. Drew probably have a pullback. I don't know how far. I personally wouldn't, if you didn't game a quick bounce, I wouldn't short it here. The breakout's bullish, and we're probably going to continue on up. And I can tell you, I have pretty good degree of confidence, a fairly high degree of confidence we'll go on up there. So now where am I going with this? Well, this, the gold and silver traders, they get dumped this morning. Everyone's rah-rahing little peace talks in Ukraine, Russia. Ridiculous in my opinion. Fundamentals are driving this market. They could kiss and make up right now, and it's not going to change or alter what's on the charts. My intermediate to longer term bearish outlook. So take advantage of these news-driven rips and dips to close out positions like this morning, or enter positions to close out that crude short that was based on the big drop on the news, that final leg down. It hit resistance. You could have reversed, gone long for the bounce, made good money already on that. Likewise, you had gold and silver pull back to those support levels, and those were also covered in previous videos. And so in here in the euro, you've had that pop in the euro and pulling back. And again, so the best way to do it is to have your limit orders in place. If you were trading the euro, you took the breakout, whether you did it on a buy stop or you just went long manually, you could have taken it out there. All I wanted to say is this again: the don't ever underestimate the impact. I've covered it many times in the past. I know there's always new subscribers here. There is a direct and long-standing correlation. It's an immutable correlation, really, between gold and the U.S. dollar. Somewhat immutable. But what I mean to say is gold is priced. The gold we're trading, gold futures or GLD, the ETF, and most, but not all gold around the world is priced in U.S. dollars. So it's very simple. When the dollar weakens, it takes more dollars to buy 1 ounce of gold. So if you freeze supply and demand in a vacuum, make them equal, that is an immutable relationship right there. In other words, if the dollar goes down X, gold's going to go up Y, because it costs that much more in dollars to buy 1 ounce of gold. Okay, so where it's somewhat flexible is the fact, yes, sometimes there can be overwhelming demand for gold. Even when the dollar is rising, gold can still go up or maybe go down less. Okay, so that's part of it. We can, the charts will help us determine that. All I am trying to say here is it is a 110%. It is a tailwind or bullish for gold when the dollar's falling and the euro's rising. Why do I keep talking about the euro? Well, the euro is the largest component by far, without a close second. The closest second, or the second largest weighting, is the yen, but that's I think like 23 and some percent, where it's about a 57.6% weighting in the euro. I'm talking about the U.S. dollar index. So you can the euro is almost an inverse chart of the dollar, is what I'm trying to say, and that's why I'll chart it this way. And of course, that way, because if the euro goes up, that's bullish for gold and silver. Anywho, that's it. So I think the fact that gold and silver were down this morning and when this rallied, there's a subset of traders that just don't realize that relationship, and that's why I put those hard buys on gold and silver and got them out to you right when we hit those levels, because this breakout. So like I said, reaction, we've already had a reaction, so that part of it's right already. There's the reaction. Whether there's more of a reaction, a consolidation, whether that's the end of the run or not, only time will tell. But I don't think the reaction is going to be very deep. I don't foresee anything's possible. Of course, anything's possible. We could backtest the trend line. If we do, that would be an objective entry. But I think this move caught a lot of traders off guard, and you're going to see position squaring. You're going to see shorts that are getting squeezed out, euro shorts, and bulls that want in. And so anywho, let's not overanalyze it. All I can tell you is now a break above today's high should open the door for run up to my next target there. And that's going to be quite bullish for gold and silver. If so, again, it's a tailwind for those. So it doesn't guarantee they're going to go up, but it can only help them from that perspective. Again, I'm talking about the the way they're valued. So when you have gold and silver falling to support, after, don't let's not forget, after a few weeks back I issued the long-term buy signals when we broke out of the triangle pattern on the weekly and daily charts. That was very bullish, and so this is that initial correction after that big rip we had. So all right, I think that makes sense, hopefully. And if not, and of course the miners should rally in sympathy with the metals. And if nothing else, here, let's go to the metals. If nothing else, look, it's simple. If you're an active trader, even a long-term trader, however you want to trade, the longer term you're looking at, and if you go on the weekly charts, there's still more downside. We still haven't even back tested the triangle pattern we broke out of on the weekly. I don't think we will, and if we do, I'll talk about it at the time. If that happens, we'd have to have more downside. But what I was getting at is, you could have, as an active trader, pressed an active trader means you take a little bit heavier position and keep a tighter stop, and then swing it up. And I showed you my targets on the chart. I believe the arrow breaks. That's roughly 1950 is that first resistance level, and then you had a trend line here that are going to come in roughly together. We might back test that, have a reaction around there, 1950. Excuse me, and then up about 1978 or so, and quite possibly more. Remember, we had a powerful breakout on the weekly chart. I remain longer term bullish on gold. It is believed to be still in a bull market. It's been for many years. We had about a year-long bull market, sideways or slightly down correction, and I think that correction is likely over, and the next wave up is upon us. That's my overall thinking, but day to day, week to week, even sometimes minute to minute, I'll let the intraday charts be my guide. I'm not going to be, aggressively long or short if the 60-minute chart is telling me otherwise. Alrighty, so that's gold. Nice reversal so far, and again, just this is another example of how the technical analysis is just playing out so well. Look at that, almost a perfect kiss. I don't know if you can make it out in the video. We had a nice reversal so far. Nothing huge, but if you trade gold futures, GC, let me show, it's better than 1%. I'm trying to measure it up, maybe 1.5%. I have to drag that line. A single contract of GCs represents about $191,000 per contract in gold. So if you make 1%, 2%, we'll probably be up 2% by the time we hit that first target. You made enough money to go out and buy a nice steak dinner, and quite a bit more actually, of course. All right, next one is silver, and then we'll move on here. SI silver again. Silver, you get more juice. I've been leaning towards, for months now, telling you I've had a preference on silver. It's almost like trading gold, but a little bit more on leverage. It just tends to, it'll follow gold, number one, but then it moves in bigger percentages. So if you're right on a short trade, you're going to make more usually on a pullback in silver. And if you're right on the direction of the precious metals on the long side, just like there, I just showed you that if you caught took the buy signal at $24 today, you're up 2.7% right now, and you're already at that first target, 24,658. And whether we get a reaction or not, like I said, it was a powerful breakout in the euro today. And so, if you're not a very active trader, I'd just sit tight. We could just blast on through there. I had a line there, I believe I did this morning. I added it in after I took the screenshot. I didn't even have time. I wanted to get the video out, those charts out to you guys right away. So I'm going to put the line right there now. That is about 25,164. That's that second target where I had a reaction, and then 25,673. And at this point, look, if you took it anywhere off there at 24 or even halfway above, whatever, you can set your stops at this point to break even, and then you lose nothing. That's with any trade. Once it starts to pan out, especially after your initial targets hit, you should always ratchet a stop up. There's no reason to ever let a trade that gets, working out real well that you took here lose all those profits. You ratchet up stops along the way, either manually. You can set trailing stops. I prefer manual stops, but I also have the luxury of being in front of the computer all day, so let you guys figure that out. And there's also a potential divergence here on the PPO as well. All right, so that's it. I like precious metals. The other day I did a pretty extensive coverage of bonds, showing you the long-term rates are approaching key levels on the 10-year and 30-year bond. We could get another leg down. It's more of a harder buy on gold and silver, but again, it's all about being diversified. So there's the 60-minute chart, divergent low, breakout. It was pretty impulsive. You have my targets there. You can see them on the site. Just zoom in, click on the chart, it'll expand, and then if you have a scroll wheel on your mouse, you zoom it. If not, just use the zoom function on your browser, and you can go in and see details on those charts. So that's it. Not much more to add. And of course, I always do my best to list the ETF options. With futures, they're leveraged. Bonds don't move as much. Crude, we're swinging crude. Crude's moving up and down double digits in a single day in many cases lately, 10% or more. Treasury bonds, if they go up 2%, that's a big day. So if you're going to take TLT, you got to buy a lot of it to make it worth your while. A lot more at least than, say, crude oil. So, but that's what it looks like here on the daily chart, and there's the weekly chart. The really bigger picture that I'm looking at here. This is a nice support level, 128.56. Why is it nice? A lot of reactions along there, and this is a weekly chart. We're going back to 2015. Big major top right there, big drop, and then a big breakout candle when we finally took it out, and that launched this whole big thing there. And now we pulled back to that level, and we didn't just pull back to support, we pulled back with positive divergence. But as I mentioned, it's not an all-in moment screaming bullish because we have a primary uptrend line there. Now, I think I already highlighted this in the video or outlined this. Look, probably do something like this. We'll probably hit that trend line. So right now I'm looking at a bounce trade, and you can see on the weekly chart there's the next pretty decent resistance. And so anywhere really within this wedge, this is what I think Treasury will do, continue to wedge down, and ultimately, again, near term, I'm watching this because this is a weekly chart. Here's potential divergence, is what I call potential. And I differentiate that from what I call confirmed. They're just terms I've made up because the indicators are pointing lower. They need to cross over. The PPO needs to cross over and put in a higher low to give me confirmed divergence because it's a momentum indicator, and it could keep heading lower. So if we just crap out here, but look at it, here's the way I see it. If we crap out and this little breakout I give you on the 60-minute chart doesn't pan out, this is what it would look like if we take another sharp leg down. And then I just take this line here, and as long as I don't drop that line below parallel, as long as it's parallel or above, upward sloping, then I have positive divergence. And if we get a reversal, which you see that's a beautiful trend line, I think it's likely, then that will be, to me, a more aggressive and that's also if we get there, that would be a more of a trend or longer term swing trade. Right now it's kind of a tactical quick trade. The 30-year, you can see there's quite a bit of room left before the before you hit the trend line, but you can see here you've got some pretty strong negative divergences forming on the 30-year yield. Either way, revisit that video. It was just out within the last week or so when I covered the treasuries, so you can get my thoughts there. But just wanted to point out ZN also, if you trade the 10-year, you want a little less volatility. You have, the shorter the maturity on treasury bonds, the less volatile they're going to be. There's a 10-year. It broke out as well. You can see my targets: 122.219, 123.117, 124.068, and 125.208. So if the breakouts fail, I'll just revisit it at lower levels. If the divergences burn through on the 60-minute chart, turn my focus back to the weekly charts and wait for the next setup. All right, next up. Okay, lumber. We'll go back to the other day. I had multiple targets listed on this 6-month chart. And then told you guys I covered here when that 122 target was hit. Let's go back to the 60-minute chart. You can see it better. There it is. And so what I noticed is we were holding that support. It was a good level to cover. I think we made, and that one again was posted as a setup. So you had plenty of time to act on it when it broke down. That was our entry point on the break of the bearish rising wedge. We swung lumber down to about a 24% or so profit. Nice trade, hit that target, and so that's where I went long recently. We had a bullish falling wedge, 60-minute divergence, and we're starting to move up, and we've regained. We slightly undercut the support level, and that's, I like to see that. It washes out, clears out some stops. Anywho, it's a quick trade for me. If it pans out, we're looking at about 11, almost a 12% run, targeting just below that 124.50-ish resistance level on LB. And guys, if you're new to the site, I've said this often. I don't, to the best of my knowledge, there is not and has never been a ETF that directly tracks lumber prices, lumber futures. Like the best you have are CUT and Wood, CUT and WOOD. Those are two ETFs that trade or track, hold timber and forestry companies. Now they will, when you overlay the charts of lumber and those companies, in the long term they're positively correlated, but in the short term they can be disconnected because they're individual companies and they're going to be subject to the whims of the stock market sometimes. When there's a lot of selling. So really, what I'm trying to get at, there's no direct pure play if you don't trade futures, and it's a pretty hefty contract too. If it's not your thing, and it's not the most liquid contract, does not trade around the clock like the stock futures, index futures only trades like regular. I think I know it opens at 10 a.m. every day and stops trading at 4, and LB is about 112,000 per contract is what you're exposed to. But like with any futures, you don't put that up. But it's what you're at risk of. So in other words, if you make 10% on one contract, you're going to make $12,000 or so, 11,200. Likewise, you'll lose that much. So just kind of know what you're trading. And if you don't know futures, stay away from them. Cut your teeth on trading ETFs. That's a safe bet to start with, especially over individual stocks. You don't have the risk. And then, if you get to the experience level and you're ready to do that and you move up, I just cover them because that's, basically this whole site is just my kind of journal. I'm showing you what I'm trading and what I'm seeing, where the opportunities are. All right, I think I'll wrap it up here. That's all I wanted to cover for now. The cannabis stocks, no update there. The market's still holding up right now, so the dash for trash is still in play. I'll let you know if I decide to cut the cord on those. There's really they're all up slightly today. What I wanted to get to is just QQQ real quick and show you the rejection. I'll go to the daily chart. There's the 200 we kissed, and so far, boom, there's the rejection off the 200. This is a 1-minute chart, and so, well, obviously I want to see us go red. That's yesterday's close. There's the gap. So what they're doing is they're backfilling the gap right now, and always talk about what quote unquote should happen, not what I think is going to happen, just what should. If this, if the trend, near-term trend is still bullish, no doubt about that. This is just a little fade of the open, pop at the open. But this is where the dip buyers should step in. Usually when a gap is backfilled, that's where, if you're in a bull trend, that's where the bull trend will resume. So if you are bullish and long, or want to get long, or you wanted to, let's say you just faded the rally because you knew we hit that 200 today that pointed out earlier, there it is. You can make a quick trade. You can trade QQQ, NQ, MNQ. Those are the mini contracts of NQ, and it'd be if the gap is backfilled, you're good for about a 1.5% trade. And the way it works is be looking at these levels. Remember, I've been pointing out these divergences for a while. I told you I started layering back into some swing short positions recently because of that. And again, I viewed today's pop up as also as an objective shorting entry. And here's what has to happen. Here's what has happened. This is the primary 60-minute trend line right here. Uptrend line, breakdown, back test number 1 right here, back test number 2 today. Again, there's a wedge. The divergence that we had in place starting here has only grown larger, and you have a breakdown. And sometimes you break down and never look back. Sometimes you break down and back test. But if we go up much more, they can burn through that divergence, and that's not going to be the best thing near term. It means they're going to probably make a run up at those more significant big resistance levels overhead, like that 380-ish level right there. So we'll see. We'll take it one day at a time. And remember, this is only one of, or should be only one of many positions in a portfolio. And that's the benefit of diversification. It works just as well in active trading as it does in investing. Don't put all your eggs in one basket. If one thing's going down, hopefully you have 5 other positions going up that day that are going to offset those losses. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.